BHP profits are in, beating analyst expectations. I'm joined by Steve Bartholomeusz from Business Spectator. Steve, what drove the result?
Combination of things, but fundamentally what Andrew Mackenzie talks about is his productivity drive. So they've cut costs in a really significant way. So annualised it's running at about $4.9 billion. By the end of the year it'll be 5.5 in the period since he became CEO. So $5.5 billion out of cost is not a bad effort. They're just squeezing more out of what they've got. So a lot of this is coming out of just doing little things better and by putting a lot of pressure on their contractors. The contractors are bleeding because BHP, Rio and the like are trying to undo all that cost inflation that occurred when the contractors were in the driving seat. So we're seeing quite a lot of pain being inflicted, but it's showing up as benefit for the big miners. They've also, and he said he would do this, basically truncated the project pipeline. You'd remember that during the Cloppers era, the growth era, when commodity prices were soaring, BHP was spending something like $80 billion over 5 years in new projects. Mackenzie stopped that, so that their capital expenditures are going to drop to about $16 billion and keep falling, which is freeing up cash flow. So the striking aspect of this result was there's a 65% increase in cash flows. Cash is now pouring through the place over this lower cost base. Some of that will be given back to shareholders, sort of quite a meagre 2 cents a share increase in dividend, and there's a hint of more capital management later on in the year if things obviously remain stable. Some of it's being used to improve the balance sheet. I think BHP has got about $27 billion of debt. They expect it to get down to $25 billion of debt, net debt by year end. And there's clearly a little bit of nervousness about the outlook and a desire to make sure that the balance sheet is bulletproof, because they're quite gloomy about the near-term outlook for iron ore. And iron ore, while it's only part of a very diversified portfolio, small movements in the iron ore price have very big impacts on their bottom line. So I assume that part of this focus on the balance sheet is insurance against some sort of meltdown in the iron ore price, which is possible.
So why are they so worried about the outlook going forward? What's their concern about the global economy?
It's not so much the global economy. It relates to China and China's demand for iron ore and the supply of iron ore. If you remember, Rio, BHP, Fortescue, Vale have all got massive increases in production flowing, and they're still flowing and they will continue flowing for the next several years. So a huge ramp up in production from the big, low cost, high quality producers at a time when, and this is BHP's view of the world, but it's one shared by many analysts, the composition of China's growth is changing. So it's getting away from that sort of steel-intensive, infrastructure-led investment to more of a consumption mode. So if China's demand for iron ore starts, or the rate of growth in demand slows at a time when the supply is pouring into the market, clearly the price is the correcting mechanism. And so a lot of analysts think that where today the price is around 120, and it's come down from multiples of that, they're thinking that very near term it'll be down in the 80s. And so for a BHP or a Rio, that's a huge drop in profitability.
So that's a big, interesting sort of question then for BHP, because they've done a great job in terms of diversifying their portfolio, haven't they? So how can they offset that potential drop in the iron ore price? And for someone like Rio Tinto, who is so heavily reliant upon iron ore, 97% of their revenue comes from that, that's going to be a worry for them, isn't it?
97% of their profitability, because they've got a lot of stuff that doesn't actually generate any profits. It's a bigger concern, obviously, for Rio, because at the moment they are completely iron ore focused. What they're both trying to do is to, and it sounds sort of counterintuitive, they're both trying to drive increased volumes because they are the low-cost producers. So they would hope that their volume displaces high-cost volume. So they're both lifting volumes while reducing costs, which is the productivity kind of equation that they're both pursuing. For BHP, it's a little bit less of an issue, because while it would impact their bottom line, they have massive met coal business, but a massive, obviously, petroleum business, and at a degree of diversity that's greater than any other resource company at the big end of town. So they've got some insulation, some insurance, big copper business as well. Rio's trying to build their copper business. If they can ever get an agreement with the Mongolian government over Oyu Tolgoi, they'd have a very substantial copper business. And in the meantime, everyone's trying to cut the costs on those businesses like aluminium, which have been going nowhere and don't make much of a contribution. They're also both trying to trim their portfolios to focus on those assets which have a hope of generating a decent return on capital. So if you look at the famous BHP bubble charts, during Marius Klopper's time, when they were investing huge amounts of money in growth projects, that chart was full of bubbles to the point where there was no white space. Today, the Andrew Mackenzie growth chart, the pipeline chart, there's still plenty of bubbles, but there's a lot of white space amongst them, and so they're stripping capital out of their forward pipeline of projects, which will allow them to strengthen their balance sheet. And the shareholders put a lot of pressure on the resource companies to give them what they didn't get during the boom years, which is bigger cash returns, either through dividends or capital management. So we've seen that sort of changing of the guard and changing of the eras in the resource industry from that boom time and aggressive growth to a much more defensive, much more introspective mindset.
One of the areas that BHP is focusing on, though, is natural gas and fracking in the United States. How are they progressing in terms of their production there?
Well, they're on track. I mean, the shale gas business, the onshore oil and gas business, because they're in liquids-rich areas in the Eagle Ford part of the states, was supposed to lose money this half in an accounting sense, and it did. There's a very high level of depreciation and amortisation, so non-cash charges against that business because it's so new and because it's very capital intensive. You put a lot of capital in the ground before you start pulling the liquids out. And on their projections, that'll be the case for the next couple of years. So around about 2016, I think they get to a kind of a cash break-even point. And by 2020, they've been saying that they'll get $3 billion a year of free cash flow out of that business and be profitable. So that's a long-term investment. But of course, that's only part of the BHP petroleum business, which has got oil wells in the Gulf of Mexico and Bass Strait and Northwest Shelf interests and the like. So that petroleum business is a strong profit contributor. Hasn't actually produced lots of profit growth in the last couple of years, but it's a potential source of growth in future.
Steve Bartholomeusz, thank you very much.
Thanks, Jackson.